Gold isn't just holding firm, it's broadcasting a currency problem in plain sight, and the loudest people in the room are trying to explain it away as just another safe haven pop, because if they admit what's really happening, they have to admit what breaks next. And later in this video, I'm going to give you the two levels that matter. The calendar window that can turn this from a grind into a gap, and the simple checklist that tells you whether this is a controlled retest or the start of something much more violent. Because the hidden mechanism isn't in the headline spot price, it's in the plumbing. And that's where the real pressure starts. Look at the tape right now and notice what's unusual about the behavior, not just the number. Gold just pushed into record territory above the $4,600 area in the last couple sessions, printed fresh highs, and yet instead of collapsing back into a messy giveback, it's been hovering just below that record zone even as people take profits. That matters. It matters because the most common failure mode after a euphoric spike is a fast air pocket, a hard retrace, the kind of move that convinces late buyers they were wrong and convinces skeptics they were right. But gold isn't giving them that emotional reset. It's staying elevated. It's staying sticky. And when a market stays sticky after a headline shock, it's rarely because everyone suddenly got spiritual about it. It's usually because someone is being forced to do something under the surface. And that's not the part that gets reported. Here's that. The conflict that makes this setup so combustible. The official story wants you to believe the system is stable and policy is in control, while the market is quietly paying up for neutrality, paying up for an asset that doesn't need a central bank's permission to be credible. When currency stress builds, it doesn't announce itself with sirens. It starts as little cracks. The dollar softens when it shouldn't. Funding tightens when the press releases say conditions are fine. Certain currencies start wobbling in ways that force hedgers to wake up. And suddenly gold isn't a trade, it's a hedge of last resort. And if you understand that chain reaction, you stop asking, why is gold up? And start asking, who is trapped? And what are they going to be forced to buy next? Because if this one level breaks, the math changes. Now, let us ground this in what we actually know right now without turning it into a fairy tale. In the last 48 hours, gold surged to new records around the mid-4600s, then steadied just under those highs as traders booked profits. And that steadiness is the tell. At the same time, the broader backdrop has been packed with political and geopolitical stress, and markets have reacted in the classic order. The dollar weakens, equities wobble, and non-yielding assets get a bid. But here's the trap. The safe haven label is true and still incomplete. Safe haven is the headline. Currency stress is the mechanism. And the mechanism is what tells you whether this is a one-week story or a multi-month repricing. Think about what currency stress actually means in real life. It's not just a chart of a currency pair drifting lower. It's the rising cost of staying hedged. It's the growing fear that policy becomes political, that the rules become negotiable, that the central bank's independence is questioned, or that trade flows and sanctions start changing what can be settled, where, and in what currency. In the last couple days, you've had public commentary and reports swirling around pressure on the Fed and debates over independence, and the market doesn't wait for a committee to agree on the truth. It reprices the risk premium. The moment participants suspect that policy could be coerced, the credibility premium in the currency starts to erode. Even if nothing happens today, the discount rate changes. That's the hidden tax. And gold is a thermometer for that tax. But I want you to notice something most people miss. Gold in US dollars is the billboard, but gold in other currencies is the smoke alarm. When the dollar is stable, gold can rise for a dozen reasons, and skeptics can shrug it off as speculation. When the dollar wobbles and gold still rises, skeptics call it risk-off. But when gold priced in weakening currencies starts pushing to extremes, that's not a US story anymore. That's a trust story. That's a settlement story. That's what is the neutral reserve when the rules feel shaky. And that's why gold can hold firm even when the daily news cycle is trying to whipsaw you into selling it. Because this move isn't emotion, it's math. So let's walk the math. Currency stress forces hedging demand. Hedging demand forces collateral demand. Collateral demand forces participants into the most liquid, least politically encumbered stores of value. And when the market senses that the risk-free asset is being relabeled in real time, the scramble isn't for yield, it's for certainty. Gold doesn't yield, gold doesn't promise, gold doesn't care who wins an election, it simply settles. And in a world where the cost of being wrong about policy credibility is existential for institutions, settlement is the product. That's why the metal can hold firm even when the headlines change every 12 minutes. But the next detail is what flips the whole setup. The price you see is always the price that assists binding the system. Gold is one of those rare markets where the paper layer can absorb shock longer than you think, and the physical layer can tighten without immediately showing up in a screaming spot chart. If you only watch spot, you're watching the theater. If you watch the market structure, you're watching the script. The futures curve, the spreads between near month and far month, the way liquidity behaves around delivery windows, the behavior of option dealers near big round number strikes, those are the tells. Because in stress regimes, price discovery doesn't happen in a straight line. It happens through forced hedging, tight spreads, and sudden repricing when someone can't roll their exposure cheaply anymore. And that's where the real pressure starts. Let's bring in the calendar, because why now isn't a vibe, it's a schedule. We're in January. Liquidity is thinner than people admit. Positioning is being rebuilt after year end. And markets are hypersensitive to policy headlines because the year AS first major policy and macro prints set the narrative. Add in the reality that options positioning tends to cluster around big psychological levels, like the $4,600 zone everyone can see, and you have a setup where the calendar itself becomes the catalyst. Into monthly and mid-month windows, dealers are forced to rebalance deltas, funds rebalance exposure, and the market can suddenly move faster than the news can explain. And when the move is driven by hedging math, it doesn't ask your permission. Here's the clean mechanism explainer, without jargon for jargon's sake. Options dealers are not bullish or bearish, they are short risk and long math. When a lot of call options sit near a big strike and price approaches that strike, dealers who sold those calls may need to buy the underlying to hedge. That buying can push price higher, which increases the delta, which forces more buying. That's reflexivity. That's how a calm grind turns into a squeeze. On the flip side, if price rejects hard from the strike zone, dealer hedges can unwind, causing a sharp drop that looks like profit taking, but is actually mechanical selling. This is why you can see violent intraday moves that feel emotional and yet are almost entirely mathematical. And the reason it matters this week is simple. We re-sitting near a level where hedging flows can dominate real buying and selling. Because if this one level breaks, the math changes. Now let's stack proof, because one argument is entertainment and 5 arguments is conviction. Proof point 1 is the tape itself, a fresh record push above $4,600 and then a refusal to collapse, even with profit taking. That's a structural tell, not a moral one. Proof point 2 is the currency backdrop. The market has reacted to policy credibility questions and geopolitical stress with a weaker dollar and a stronger bid for non-yielding havens. That combination, dollar softening while gold stays bid, matters because it hints the demand isn't purely out panic, it's reallocative. Proof point 3 is the cross-metal confirmation. Silver has been ripping to records as well, which is what you see when the market is sniffing out broader monetary stress rather than a single asset story. Silver is volatile and often late. When it follows hard, it's a sign the trade is spilling into the wider complex. But that's not the part that matters. The part that matters is what these moves are forcing institutions to do. Proof point 4 is institutional behavior that doesn't show up in your social feed. Central banks have been a persistent pillar of gold demand in recent years, and the stated motivations are not momentum. They're diversification, sanctions risk, and reserve credibility. When official sector demand is steady, it changes the character of dips. Dips don't look like relief. They look like procurement opportunities. And that matters for holds firm, because a market with strategic buyers beneath it behaves differently than a market propped up by tourists. Proof point 5 is market structure. When stress is real, you tend to see it in the curve, in the willingness to pay for immediacy, in the tightening of spreads, and in the way the market treats delivery windows. You don't need exact inventory numbers to see this. You just need to observe whether the market is paying you to wait or charging you to get metal now. When immediacy gets priced, it's a sign the paper layer is starting to feel the physical layer's constraints. And that's where the real pressure starts. Let S talk about those constraints in a way that doesn't pretend the world is one neat warehouse. Not all reported inventory is the same thing. Some metal is eligible or stored, some is tied up, some is pledged, some is allocated to someone else's balance sheet, and some is truly deliverable into the exchange mechanism without friction. When the market gets stressed, the distinction between exists somewhere and can be delivered now becomes everything. That is why you can have headlines saying inventories are fine, while the tradable float is tight. It's the difference between having water in the reservoir and having water in the tap. And when the tap starts sputtering, spreads start talking. Then there's the global pipe, the flow between vaulting hubs, refiners, and end demand. In normal times, that pipe is taken for granted. In stressed times, logistics and financing become the choke points. If financing rates rise, holding metal becomes more expensive. If trade policy becomes unpredictable, the friction of moving metal rises. If certain jurisdictions start pricing in settlement risk, the preference for where metal sits changes. Institutions hate surprises, so they preposition. They move collateral. They adjust their vaulting preferences. Those decisions rarely make headlines, but they show up in the market's behavior. Sudden bursts of demand, tightness in certain forms, and a persistent bid even when the news cycle turns quiet. Now, here is the hidden detail that reframes the whole story. The spot price can lie by omission, but the spread tells the truth. A market can print a clean spot chart while the internal structure is flashing warning signs. If you see gold holding firm near records while the curve behaves like people are willing to pay for immediacy, that is not a feeling story. That is a funding and availability story. And if you see cross-currency gold making outsized moves, that is not a US, only safe haven story. That is global currency stress expressing itself in the one asset that sits above any single issuer. Everyone's watching the headline, but the signal is somewhere else. So what does this force participants to do right now, this week? If you're a corporation with global exposure, you hedge. If hedging costs rise, you reduce risk elsewhere. If you're a fund with leverage, your broker wants more margin when volatility rises. When margin rises, you sell what you can, not what you want. That creates sudden downdrafts that look like gold is failing, even when the larger thesis is strengthening. And if you're a dealer, short options near a big strike, you hedge mechanically, which can produce melt-ups that look like mania. This is how you get a market that feels schizophrenic, while it is actually very logical. It is cycling through who is forced to do what. And the only way you get emotionally manipulated by that cycle is if you confuse noise with signal. Let's install the psychology shield now, because most people don't lose because they're dumb. They lose because volatility is designed to farm their reactions. When gold spikes, you'll hear too late. When gold dips, you'll hear it's over. When gold chops, you'll hear dead money. None of that is analysis. It's emotional governance. The market's job is to transfer assets from weak hands to strong hands, and the strongest hands are the ones that can sit through ugly candles without changing their thesis every hour. If you want to stop being a liquidity donor, you need one simple rule: separate the trend signal from the noise. Trend signal is structure, higher lows, reclaim levels, spreads that confirm, and sustained bids after profit taking. Noise is the wick that exists because someone got margined at 10:37 a.m. in a thin session, and that's not the part that matters. Now I'm going to give you the two-level framework, because you don't need predictions, you need conditions. The first level is the fuel line, the area where pullbacks stop being scary and start being supply. It's the level where buyers prove they're not just chasing, they're defending. When price holds above that zone, dips tend to get bought quickly, and every attempt to push it lower becomes a gift to someone bigger. The second level is the liquidation line, the area where a break changes behavior, where leverage starts coming off, where the market shifts from buy dips to get flat, where the narrative flips because positioning is forced to flip. I'm deliberately not giving you fake precision to the dollar because the exact line depends on where your feed prints and how the market trades the next few sessions. But conceptually, it MS this. If gold stays constructive near the record zone and refuses to lose key support on pullbacks, the trend signal remains intact. If it loses that structure cleanly and fails to reclaim, you shift from retest to deleveraging. Because if this one level breaks, the math changes. So let's map the next 7 to 14 days with a clean two-scenario lens. Scenario 1 is the controlled pullback and retest. In this scenario, gold cools off after the record push, sellers test the bid, and price dips into support zones, while volatility shakes out late leverage. The tell here is not whether it dips, the tell is how it dips. Does it dip on heavy stress with spreads widening and liquidity gapping, or does it dip in an orderly way and get bought? Does it reclaim quickly? Do you see the market refusing to spend time below the key zone? If the pullback is controlled and the reclaim is clean, it's a sign real money is supporting. And the move was not a one-day headline. In that case, the record zone becomes less of a ceiling and more of a checkpoint, and the next push higher can happen on less obvious news than people expect. That's where the real pressure starts. Scenario 2 is the continuation squeeze and gap risk. In this scenario, gold doesn't give the market the pullback it wants. It grinds higher, pushes through the obvious psychological levels, and forces hedging flows to accelerate. If options positioning is heavy near the big strikes, the act of breaking higher can create reflexive buying from dealers, which pulls more participants in, which turns a grind into a squeeze. This is the scenario where everyone who is waiting for a better entry gets emotionally coerced into chasing at higher prices, and the market can gap on policy headlines, geopolitical escalations, or sudden currency moves. In this scenario, your biggest risk isn't being wrong about direction, it's being wrong about speed. Because gold can whip around violently even if the thesis is correct. You can be right on the macro and still get wrecked on the path if you treat a volatility product like a savings account. That's not fear-mongering, that's the nature of the instrument. Now, let's confront the counterpoints that can weaken or invalidate this story, because credibility comes from naming the ways you can be wrong. First counterpoint, real yields can spike. If markets suddenly price tighter policy or higher real rates, non-yielding assets can get hit fast, even if the long-term narrative remains supportive. Second counterpoint, forced deleveraging can create an ugly liquidity event. When markets de-risk, gold can get sold to meet margin elsewhere. That doesn't mean gold is broken. It means gold is liquid. Third counterpoint, policy can surprise on the hawkish side, or interventions can stabilize key currencies, reducing the urgency of hedging demand. Fourth counterpoint, positioning can get crowded. And when it gets crowded, the market punishes impatience with sharp drawdowns. So the way you stay sane is by watching the tells, not the takes. Watch whether gold can hold structure after a shock. Watch whether the dollar's weakness persists or snaps back. Watch whether spreads and curve behavior confirm the stress narrative. Watch whether risk assets stabilize while gold stays bid, because that is a different story than panic day. But that's not the part that matters. The part that matters is what the system is incentivized to do if credibility keeps getting questioned. Because here is the uncomfortable truth. When trust is the variable, it doesn't revert on command. You can't memo trust back into existence. If market participants believe policy independence is under pressure, if they believe trade rules can shift overnight, if they believe settlement risk is rising, they don't wait for a press conference to tell them everything is fine. They diversify, they shorten risk, they move to assets that are harder to sanction, harder to dilute, and harder to politicize. That's not conspiracy, that's incentives. And in that incentive structure, gold's role expands. So what should you watch next, specifically, without turning your life into a Bloomberg terminal obsession? First, watch the behavior around the record zone. Does gold keep returning to it like a magnet, or does it recoil and struggle to get back? Magnet behavior suggests acceptance. Recoil suggests exhaustion. Second, watch the nature of dips. Are they shallow and quickly absorbed, or deep and lingering? Quick absorption is supportive. Lingering weakness is a warning. Third, watch currency stress indicators in your own world. Does your local currency feel stable, or are you hearing more chatter about hedging, capital controls, intervention, or policy pressure? You don't need to predict the entire FX complex. You just need to sense whether the discomfort is spreading. Fourth, watch cross-asset confirmation. If silver remains strong, and industrial metals don't collapse, it suggests the move isn't purely panic, it's broader monetary repricing. Fifth, watch the calendar. Liquidity thins at awkward moments, and the market loves to do its worst work when people are least prepared. That's why I keep saying the calendar is the catalyst, because the calendar is when math-driven flows hit. And finally, I want you to internalize the viewer psychology shield one more time. You will be emotionally manipulated by volatility. You will see a sharp dip, and someone will say, it's over. You will see a sharp rip, and someone will say, too late. Both of those voices are trying to pull you off structure and into impulse. The way you don't get farmed is by deciding in advance what confirms, what invalidates, and what you do in each scenario. Not because you can control the market, but because you can control your reaction to it. If you can do that, you stop trading headlines and start tracking mechanisms. And that's the difference between being entertained by markets and being prepared for them. So here, it's the clean close. Gold holding firm near records is not the end of the story. It's the beginning of the diagnostic. If we get the controlled pullback and retest, watch for quick reclaim and strong absorption. Those are signs the strategic bid is real and the market is digesting higher. If we get the continuation squeeze, respect the gap risk and the speed risk, because math-driven moves don't wait for consensus, and the whip can hurt even if the direction is right. Either way, the hidden detail remains the same. The price can lie, but the structure doesn't. Watch the curve, watch the spreads, watch cross-currency behavior, and watch how the market behaves around the obvious level everyone is staring at. That's where the market tells you whether this is a story about fear or a story about trust. And if you are the kind of investor who dies, rather be early with a plan than late with an excuse, stay close to people who watch structure instead of vibes, because the next 2 weeks are going to reward discipline and punish impulse, and that's where the real pressure starts.